So not only are September's inflation CPI numbers expected to be high, but October's CPI inflation numbers, those are expected to be high as well. Hi guys, it's Stock Curry, and over the next 2 days, we have some major stock market news that could move the markets as much as 10%. In today's video, I'll explain what to watch out for so that you'll know how to trade it. So let's get into it. The Fed meeting minutes from their meeting last month came out on Wednesday, and they showed that the Federal Reserve has concerns that there might be more persistent high inflation. This stubborn inflation will keep the Federal Reserve focused on raising interest rates. Fed officials expect these higher interest rates to stay in place according to their meeting minutes, which is destroying all hopes that the Fed might turn around and start lowering their interest rates. One of the reasons we saw the stock market rise last week was because people had hoped that the Federal Reserve might actually slow down the rate of rate increases or even start lowering interest rates, much in the same way that the Bank of England did. However, the Fed meeting minute shows that those hopes have been pretty much destroyed, and that is why we're seeing the stock market fall this week. The Federal Reserve also has a new worry, and that is the big gap in consumer savings. One of the bedrock assumptions about the US consumer, and thus the economy, is wrong. Consumers are not sitting on nearly as much cash as many economists had said they were. Consumers were thought to have built up about $2.4 trillion in excess savings, and that was supposed to underpin the argument that the economy could avoid a recession even as the Federal Reserve raised interest rates at the fastest pace in decades. While the term soft landing is now gone, many central bankers, economists, and investors are still arguing that any recession we do get will be short and shallow, in part because consumers are thought to be in good economic shape. However, fresh information about U.S. consumer savings are showing that consumers do not have nearly as much savings as was once thought, and that means that the recession will not merely be a blip on the radar. Downward revisions to the savings rate, which the government published last week, indicate people have spent much of their savings. Roughly $1.4 trillion in savings remain, but it's not enough to prevent credit card borrowing from increasing and consumer delinquencies from increasing as well. Nancy Laser, the chief economist at Piper Sandler, says delinquency risk is rising, especially for low-end consumers who have exhausted their savings. As a result, U.S. banks are setting aside $5 billion in cash reserves in order to absorb delinquencies as the recession risks grow. As banks set more and more money aside in cash in order to absorb delinquencies, this means banks have less money to invest, and this in turn lowers the profits of banks. As earnings go down for U.S. banks, that is causing U.S. bank stocks to decline as well. And keep in mind that U.S. bank stocks report earnings on Friday. The S&P 500, the Dow, and the Nasdaq all closed lower on Wednesday, notching 6 days in a row of losses ahead of a key inflation report that everybody is holding their breath for. On Thursday morning at 8:30 a.m., the CPI, or Consumer Price Index for September, will be released. Consumer inflation is expected to have risen in September, boosted by an increased cost in rising rents and shelter costs. Excluding food and energy, the core CPI is expected to have risen 0.4%, slightly less than the 0.6% rise in August. And looking ahead to where inflation might be in October, the Producer Price Index, or PPI, which is how much U.S. suppliers pay for the supplies that go into the prices of goods that consumers buy, that increased in September. That means inflation will run high again in October. As the Producer Price Index, or PPI, increases, that points to future CPI, or consumer price inflation numbers, being high. And since the PPI numbers were higher in September, that means the CPI numbers should be higher in October as well. So not only are September's inflation CPI numbers expected to be high, but October's CPI inflation numbers, those are expected to be high as well. And this is why the Federal Reserve thinks inflation is going to remain high for the time being. And this is why people think the Federal Reserve will continue to raise interest rates, possibly even faster than they've already said they would. And if, in fact, the September CPI does in fact come in high, we can expect the stock market to fall on Thursday. One of the things that propped up the stock market last week were hopes that the Federal Reserve would stop raising rates and possibly stop selling off their bond assets in order to bring interest rates down. A lot of this was caused by the Bank of England, which is the UK's central bank, to start buying bonds in order to keep interest rates from going up too much. However, the Bank of England has now put out an ultimatum saying that they would stop buying bonds on Friday. That has caused the interest rates in the UK to rise once again. Not only has this dashed hopes that the US Federal Reserve might do the same, it has also caused the UK's interest rates to rise, which in turn has caused the US dollar to rise in value as well. And when the US dollar rises in value, this means stock prices go down. Stock prices are also going down because mortgage rates just hit 6.8% last week, which was the highest in 15 years. And for somebody with a credit score of 720, which isn't perfect credit, but still really good credit, that interest rate on the mortgage is 7.5%. And if all of this wasn't enough to keep stock prices falling, earnings season starts on Thursday, and not only are earnings expected to be bad, the stock market could fall significantly. The reason we could see the stock market fall so much this earnings season is because despite the fact that stock prices are already down over 30%, we have not yet seen the PE ratios, or stock price to earnings ratios, decline. What that means is, as earnings continue to decline, this is going to force stock prices to decline as well. So during this earnings season, if companies come out and they say that earnings are down by 40%, we could expect stock prices to fall by 40% as well. And that is why we can expect the stock market to continue to go down as earnings continue to decline. Earnings season kicks off Thursday before the open with Taiwan Semiconductor reporting. That stock, by the way, is down about 8% on the Hong Kong markets as their earnings are expected to be terrible. Delta, BlackRock, Domino's Pizza, and Walgreens, or WBA, is also reporting Thursday before the open. Those are all going to lead up to Friday's pre-market earnings, and Friday is when most people say that earnings season truly starts, because this is when the banks start reporting. We have JP Morgan Chase, Morgan Stanley, Citibank, Wells Fargo, US Bank Corp, PNC, and First Republic Bank all reporting earnings Friday before the open. The big one that everybody's going to be watching out for is JP Morgan Chase. They are the largest bank in the US, and they are going to be the biggest mover in the stock market. Now, one thing to keep in mind is that the stocks that are reporting this week are Dow stocks, meaning whatever happens to those earnings, they're mostly going to move the Dow. we won't expect the S&P and the NASDAQ to start moving significantly based upon earnings until next week and the week after, when technology stocks start reporting. Once those mega cap technology stocks start reporting, that's when we can see the whole stock market as a whole really start to decline. So watch out for that over the next few weeks. It is going to be major market movers, and like I said, the stock market could move as much as 10% on Thursday and Friday combined, depending upon how these earnings and the CPI data come out. If you got a lot out of this video, be a good friend and share it with your friends and family so that they will know how to prepare for the stock market as well. And make sure you hit the like button and subscribe. And if you want more great market news and analysis like this and want to know what's happening with the U.S. economy and how this recession is going to play out, make sure you watch the last video that I uploaded here.